This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the last lecture on chapter 9 of the free paper F9 lecture notes, where, if you remember, we're looking at these three special situations we've already dealt with: capital rationing, replacement, and the last one is lease versus buy, which, watch me carefully, you see as I go through, although the idea behind this I think is very straightforward, I hope so, there is one problem the examiner keeps throwing in, I don't know why, which relates, as you'll see, to the tax situation. Anyway, I don't want to spoil the fun. Look at the example with me and I'll explain the problem when we come to it. A company is considering, example 3, a company is considering whether to buy a new machine at a cost of 100,000 or alternatively to lease it for 35,000 a year. And the lease payments are payable at the start of each year. Remember, normally we assume revenues and costs are at the ends of years, but here we're told specifically that the lease payments, effectively the rent, if we rent the machine, are going to be payable at the start of each year. Buying it will involve borrowing money at an after-tax interest cost of 7%. If the machine is bought, it'll be bought on the last day of the current financial year. The machine will be needed for 4 years, and if we buy it, it'll have a scrap value after 4 years of 10,000. And there's tax. Tax is 30% payable 1 year after the end of the financial year, and capital allowances are 25%, reducing balance. Well, what are we concerned about? We need this machine, and we want to know whether to buy it or effectively rent it, buy or lease, whichever's the best is going to be whichever's the cheaper of the two. I'm not concerned about the revenues we'll generate from this machine, because whether we buy it or lease it, presumably we'll have the same production and get the same operating profits. And so it's purely a cost exercise. Which is going to be cheaper? Buying it, 100,000 and then getting the scrap, or leasing it, paying 35,000 a year? Well, what we'll do is we'll set up the cash flows for each of them. We'll work out the present value of the costs and see which is the cheaper of the two. What about leasing? Well, the costs involved in leasing are these lease payments. And what are the lease payments? We're having it how many years? 4 years? 0, 1, 2, 3, 4. Be careful though. It says, I did mention before, we're paying 35,000 a year. Normally, running expenses at the ends of would be at the ends of the year, so time 1, time 2, so on. But if we're paying at the start of the year, the start of the first year is now, time 0. The start of the second year, it starts in 1 year's time, time 1. The third year starts in 2 years' time. And the fourth year starts in 3 years' time. So there are the flows if we lease it. Now, there is going to be a tax effect. We'll worry about tax in a moment. I'll leave a big space, but let's work out what the cash flows will be if we buy it. 0, 1, 2, 3, 4. Well, of course, if we buy it, we pay out the initial cost now. How much is it? 100,000. And we get the scrap proceeds. Since it's ours, we'll get the scrap proceeds in 4 years' time, an inflow of 10,000. Now, again, there are tax implications, which is where we have a bit of a problem. We'll worry about that in 2 seconds. But otherwise, I think easy enough. One little point which worries people. The lease payments are at the start of each year. So just suppose, the companies have different year ends, but suppose the start of the first year was, let's say, the 1st of January 2017. When it says the alternative is to buy it, it says if we buy it, it will be bought on the last day of the current financial year. And of course, since we haven't yet made the decision, the current year is 2016, so we'd actually be paying for it on 31st December 2016. And some people get terribly worried and say, oh, well, 2017 is a year later than 2016. Well, I know it is a year later, but not in these days, surely. 31st December 2016, 1st of January 2000, there's only a day apart. And from a discounting point of view, it's effectively the same day. We never discount for 1 day. We're not worried about 1 day. So times 0, I don't really care whether it's December 16 or whether it's January 17, same thing. There could be other flows, if maybe if we buy it, we would have to pay repairs. Maybe if we lease it, we don't have to pay the repairs. No problem. If I told you, leasing, there were no other costs involved. Buying, you've got repairs of 2,000 a year. Fine. You'd stick in extra flows of 2,000 a year. However, where we need a bit more is in relation to the tax effect, because there is tax payable at 30% 1 year after the end of the financial year. And as far as lease payments are concerned, we do assume that lease payments are allowable for tax. Now, we assume always, as I said in an earlier chapter, we assume the company's already making lots of profits and paying lots of tax. If we lease, we've got this extra expense which will reduce our existing profits. And if our existing profits go down, we'll be paying less tax. We'll save tax. And so, there'll be a tax saving on those payments. And the tax saving each year, since tax is 30%, 30% of 35,000 is how much? $10,500. So our taxable profits are lower, our tax bill is lower as a result. We save tax of $10,500 a year. But here, be careful. When are we going to make the savings? Tax is payable 1 year after the end of the financial year. So surely the way tax works, if the first lease payment is the 1st of January 2017, they'll calculate our tax bill at the end of the accounting period. So the tax would be calculated on the 31st of December 2017. Made the payment 1st of January, but they don't calculate tax till the end of the accounting year. And the tax is payable 1 year after the end of the accounting year. So it's going to be paid, or in this case saved, on December 2018. And what time period would be that? January 17 to December 17. Well, December 17 is 1 year away. December 18 is 2 years away. So the tax saving, the first tax saving, would be at time 2. Because that 35,000 is payable at the start of the year, tax is calculated at the end of the year, 1 year later, payable another year later. So it's 2 years later. So similarly, time 1, the lease payment at time 1, tax benefit 2 years later, time 3, time 2, 2 years later at time 4, and time 3, 2 years later at time 5. It needs a bit of thought. I will give you a rule at the end, but it's only ever in lease and buy questions that this tax timing has been a problem. It's because otherwise, as you'll see, the question is so easy. I think the only way you can find of making it a bit trickier is to have this tax timing problem. However, the net cash flows as a result, if we lease, outflow of 35, and net outflow of 24,500. And then, because it's tax savings, effectively inflows of 10,500. All right, now let's turn to what happens if we buy it. Well, the basic flow is easy, cost 100, the scrap 4. But again, what about tax? Because you know from an earlier chapter, if we buy something, we get capital allowances. And so we'll save tax that way. So we'll have the tax saving on capital allowances. Well, you know how to calculate. Let's do it. I'll have to do workings. The initial cost is 100,000. The first capital allowance calculation, 25%, is it 20? Yes, 25% reducing balance, 25,000, bringing the tax value down to 75. We want the tax saving. Well, at a tax rate of 30%, the first capital allowance will make a saving of 7,500. Now, in a minute, I'll carry on, 25% each year. However, again, we need to think carefully about the timing, because this is odd. When was the machine bought? It was bought on the last day of the financial year, which, as an example, I said, suppose is December 2016. Well, I know you might not all have done paper F6, but you always get capital allowances calculated in the year in which you bought the machine. Doesn't matter when you buy it during the year, whether you buy it at the beginning, in the middle, at the end. We bought this machine in year ended December 2016. The allowances would therefore be calculated at the end of the year. They'll be calculated immediately, December 2016. When will the tax effect take place? Well, there's a 1 year delay. The tax effect is 1 year after the accounting period. And so the tax effect will be at time 1. Now, say I will give you a rule later, but it's only in lease versus buy questions we've had this problem. But the first capital allowance saving will be time 1. Let's now carry on. It's 25% each year. 25% of 75,000. 18,750. And so the tax saving that results at 30%, 5,625. That brings the tax value down to 56,250. Well, I'll put the figures on my schedule later. Let's finish the calculations. But before we carry on, before we rush along and do 25%, 25%, 25%, remember, it'll be 25% each year until the final year. And in the final year, the last year, we simply subtract the sale proceeds. But the question is, how many years are we going to do? People say, oh, in total there'll be 4. No, there'll be 4 years. There won't. And I'll tell you why. We bought it on the last day of the current year. And so, as I explained a minute ago, we'll get allowances and a saving for that year. That's 1 year. We then use the machine for 4 years, and we'll get allowances for each of the 4. In total, there'll be 5 years of allowances. We'll do 25% each year until the last year, the 5th year, when we have the balancing charge. So let's carry on the 3rd year. 25% of 56,250. 14,063, and so the saving 4,219, and the tax written down value is now 42,187. The 4th year, the allowance is 10,547. The saving, therefore, 3,164. So the tax value comes down to 31,640. Finally, though, the 5th, the last year, we don't have 25%. We subtract the sale or the scrap proceeds, which are 10,000. And remember the difference, whatever's left is a balancing allowance or a balancing charge. Here the scrap value is less than the tax value, so there's a balancing allowance of 21,640. And therefore we'll save tax at 30% of that, 6,492. Let's stick those in the schedule, and then we're almost there. The tax savings, 7,500, 5,625 times 2, 4,219, 3,164. And at time 5, what was it, 6,492? 6,492. If you're still worried about the tax, I'll give you a rule later, but as I say, it's only in these questions that it becomes a problem. But I'll give you that later. The net cash flows there we are. All right, so we've got the net cash flows under each possibility, leasing and buying. The final thing is how are we going to decide which is best? We want the one that's the cheapest. But how are we going to decide? Well, we'll decide by discounting. And we discount always at the after-tax interest cost of borrowing. It says here, the cost of borrowing money is 7% after tax. We'll discount in both cases at 7%. Now, before I do, because the discounting itself is obviously just using the tables, that shouldn't take many seconds. The point is, and we'll say a lot more about the cost of money in later chapters, there's a lot to do on it. But the point is, we might be paying interest at, let's say, 10%. But because interest reduces taxable profits, because paying more interest saves you tax, although you might be paying interest at 10%, you'll save tax at 30% of it. And therefore, after tax, it's effectively only costing 7. So, we'll discount at the after-tax interest. Here you're given the after-tax interest. If he had said the interest before tax is 10%, then you would have taken off 30%, still discount to 7. So, let's do it, and then I can tie up the loose ends. Where are my discount tables? Here they are, present value tables. The discount factor is 7%. For 1 year, 0.935, 2 years, 873, 816, 763, 713. The present values, therefore. Be careful with the signs here. You better check I don't make a silly mistake. 35,000 times 0.935. 24,500 times 0.873. $24,500 times 0.816. 10,500 times 0.763. And finally 10,500 times 0.713. The overall present value of leasing $93,607. Appreciate it's negative, it's a cost. You know, we're ignoring whatever revenue's being generated because that will be the same whether we choose to buy or we choose to lease. So all we want to know is which is the cheapest cost of the two. Well, leasing effectively is 93,607. Finally, buying, again, the discount factors. The present values. 7,500 times 0.935. 7,013. 5,625 times 0.873. 4,911. 4,219 times 0.816. 3,443. 13,164 times 0.763. 10,044. And finally, £4,629. And so again, the total present value if we buy £69,960. And so now we can make the decision, as I've said a couple of times, we want the cheapest cost of the two. It could obviously have been either, but in this case, leasing effectively 93,000, buying only 69,000, the cheaper of the two is to buy. And there we are. Now, as I was saying earlier, I hope you'd agree that this is all desperately easy apart from the tax timing. It's that's the problem. If there was no tax in here, this question, to be honest, if you've been through the earlier chapters, this question really should have been a joke. But it's the tax is the only thing that makes it tricky. And I've said several times, this tax timing has only been a problem in the exam when there's been a lease by question. And so all I can do, go back and listen to what I said when I explained the logic, but as a rule, if there's a 1-year delay in tax, if that's the rule, this is what it says here, the most common one, tax is payable 1 year after the end of the financial year. If the first cash flow is on the first day of an accounting period, then the first tax effect is at time 2. That was the situation of leasing. The flow is at the start of the period, the tax calculation is at the end of the period, which is a year later. The tax effect, a 1-year delay, another year later, at time 2. On the other hand, if the first cash flow is on the last day of an accounting period, then again with a 1-year delay in tax, the first tax effect is at time 1. This is what happened with the capital allowances. The first cash flow was at the end of the accounting period. Because it's on the last day of the period, immediately the tax will be calculated. But because of a 1-year delay in payment, the tax effect will be 1 year later at time 1. So there's the rule. For the last time, it's only lease by where that's ever been a problem in the exam. And I'm not going to explain the reason again. If it's still worrying you, look back, listen to what I was saying as we actually went through it. Anyway, there's 3 special cases. There's only one more aspect of investment appraisal we need to look at, which is the next chapter, where we're looking at uncertainty.